We're half an hour.
We're half an hour away from the opens in Hong Kong. Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man in Hong Kong. Our top stories this morning. We're taking a look at Korean stocks and the won gaining as President Trump sets tariffs at 15% exchange for hundreds of billions of dollars in investments. India, though, falls on the other side of the spectrum, facing a 25% levy that could still go together higher over its protectionism and purchases of Russian oil. Also ahead, traders pushing back bets for rate cuts as the Fed stands pat, with Chair Jay Powell citing tariff risks to inflation. And China's top leadership signals once again that ending price wars is at the center of economic planning as they seek to boost growth.
A quick look at the market action. We're seeing U.S. futures very positive, following on from the strong showing from tech earnings. But it's really also about the Fed, as it kept things on hold as expected. But Powell's strong pushback also making investors erase some of the bets of a September cut. And we're seeing that playing out in treasuries. And along with that, the bounce in the dollar, that is also putting pressure on JGBs. This is even ahead of the BOJ and the comments from Ueda-san. Of course, there's that bearish view emerging on the yen, but it is recouping some of that lost ground against the greenback. Flip the board, because when it comes to Asia stocks, it's also really been about these trade deals. And for South Korea in particular, 15% tariffs with the deal is seen as a good outcome. But this is kind of being offset by what we're seeing in Samsung that miss on earnings, despite some of these positive showings from its U.S. counterparts. And of course, keeping a close watch as well on India futures. Trump saying that tariffs on India will be 25%. There has been a bit of a view emerging that India stocks can withstand some of this, given how a lot of the negativity has already been priced in. India futures are flat at the moment. Flip the board again. When it comes to Chinese futures, we've, of course, been seeing that anti-involution rally, the Politburo readout kind of reinforcing that theme. Futures pointing to a bit of a soft start at the start of trade, and the dollar-China moves also on watch. We're seeing 720 on the handle there against the backdrop of the bounce in the dollar now being reversed slightly, Yvonne.
Yeah, the bounce in the dollar has been quite interesting, right? Because you saw basically this repricing around the Fed, where Jay Powell basically didn't cave to the two dissents that we saw within the board, which was expected, but certainly he didn't really lean into at least signaling that a September cut is coming. That's why you're seeing yields pick up, the dollar pick up. And then, of course, you mentioned, the amount of top stories today, April, is remarkable. My head's about to explode. Politburo readout, a bit of disappointment there, that there was no major stimulus. And then we got to break down the different trade deal with Korea. We can't quite call the India one a deal just yet. But yes, the highest tariff rate we've seen from India in Asia. So certainly we have to see what went wrong and how did those talks really break down?
Yeah, it's really interesting because India, if you recall, back when all these trade ructions began as an ally to the U.S. and with Modi and Trump's, relationship, they were seen as sort of front of the queue for reduction in trade tariffs. But this is where we are at the moment. And for South Korea, I think a key thing is also how they've managed to get these lower rates, which is very similar to what we're seeing with Japan, right? And that investment pledge, $350 billion, I think it also echoes what are the details for these investments into the U.S. That's also something that has been a sort of sticking point since Japan's gotten that trade deal and also the $550 billion investment pledge. Yvonne.
Yeah, it's interesting, right? Because you take a look at how these investment pledges have been country by country, and it's quite substantial, that number, right? I think it's over $1 trillion. If you look at Japan, I think it was $500 billion there. EU. Now you add Korea, South Korea to the mix there. Those are some pretty big numbers. If they don't deliver, what happens to markets, right? That certainly is something that President Trump wants, the goal of bringing manufacturing jobs back to the U.S. But if they fall short, certainly that's going to be a key question there, beyond just where these tariff rates are going to end up in the next weeks or months.
Yeah, so we're going to be continuing to track those developments along with what we've seen from the Fed, continuing to digest all that. And indeed, with Trump saying he's reached this trade deal with South Korea, imposing this 15% tariff on its exports, Seoul has also agreed to invest $350 billion, as we mentioned earlier, in the U.S. and buy $100 billion in energy products.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
Bloomberg senior editor Derek Wallbank joins us. So, Derek, let's start with Korea first. There was a bit of concern because of how close we are to August 1st, and then now we know 15% ultimately is what Korea is going to get. And key among that, how they might not be opening further access for U.S. beef, rice imports. Is this being seen as a good outcome overall for Korea?
Yeah, Averill, I think this is one of the better outcomes that you could have hoped for if you are looking at South Korea. You're getting a deal that broadly matches Japan. It is a deal that kind of comes in a little bit less than some other Asian players, a little bit less than Vietnam, for example, Indonesia. So not a bad deal if you are South Korea compared to what other things are getting inked here. It also comes with Seoul agreeing to some $350 billion in U.S. investments. This, of course, echoes the fund that Donald Trump said Japan would do to the tune of $550 billion. We'll see what that looks like going further. I mean, the devil is always in the details on these sorts of things, but we're hearing that could be rolled out over the next couple of weeks. Broadly, though, I think the mood when people are talking about Seoul is that they got a reasonably good deal, as I say, compared to what other countries are getting, especially in the region.
Derek, talk to me about India. We saw basically the rupee slump. Futures are slightly on the downside here today. Could be pretty ugly at the open. How do we end up with 25% tariffs?
Well, Yvonne, everything I just said about South Korea, put it in the mirror and flip it around, right? India here is getting what I think a lot of analysts are saying is probably on the worst end of where people thought that they could be. Remember, Narendra Modi was near the front of the line when this all started going, right? He was an early visitor to the White House. You're seeing clips on the screen of that visit. Very friendly nation. Trump actually said in his social media post talking about this that, India is a friend, but they've got a couple of strong differences here, right? Never mind that the U.S. has reached out to India as a security partner. Never mind all of the Indo-Pacific, kind of stuff. When you're talking about a pure trade relationship, you are talking about a country with a pretty substantial trade deficit. You're also talking about a country that has a lot of protection-related policies. And you also have some real differences because some of the things that Trump has been really keen on opening up for places that are really part of his own political coalition. I'm thinking in terms of autos. I'm thinking in terms of farms. Those are also some things that, that India is particularly keen to protect. So there are some real policy differences. I think, though, at this point, you also can't sit there and say, 25%, that's the last thing we're going to talk about, because Trump has also said that there should be some penalties for continued partnerships with Russia in terms of energy. That's a long-term relationship, India and Russia. We could talk for days about the ancestral reasons for that. But that is coming into focus, as is the fact that India is the eye in BRICS. And Trump has had some words about the BRICS countries and what he sees as, sort of their increasing coordination and what that might mean for the U.S. and for the dollar and global trade. So there's a lot here that's sort of headwinds, even as Trump and Modi have had a good relationship. And even as this, U.S. senior officials are telling us this is not the end of the road, even if this is sort of a pretty big hurdle where we are now. There still could be further talks. You could get to a bigger deal. We're just not there yet. And right now, this is toward the worst case scenario that people were looking at.
Yeah, it seems like an uphill battle for India from here on, Derek. But yes, as you mentioned, there's economic sticking points, geopolitical ones as well. It's getting pretty complicated. Derek, thank you for breaking it all down for us. Our senior editor joining us there out of San Francisco. Let's get to another top story here in China, where President Xi has endorsed a campaign to fight involution and reduce excess competition in the economy, signaling this is now a top priority for Beijing. Let's bring in our China correspondent, Min Lo. She's been reading this readout from the Politburo that we finally got in this meeting. What came out of it?
Yeah, before we talk about that, I actually want to point out this People's Daily editorial that came out this morning, which talked about how the Stockholm talks had really boosted trade confidence. And it seems like there is really a lot of positive momentum, at least from the Chinese side. That is expectation that maybe a big outcome could be coming, because a top diplomat in Singapore had praised the U.S. for negotiating in good faith and saying that perhaps in 3 months' time, the two sides could be doing a lot of things together. So that could be why we are seeing the Politburo readout becoming quite disappointing, at least for some analysts. You look at Macquarie, they're saying that there isn't enough signals from the Politburo readout suggesting that there's going to be imminent rate cuts, that there's going to be more stimulus coming. There isn't any signs that maybe there'll be more policy easing when it comes to property as well. So you look at the readout, the statements there when it comes to fiscal and monetary policy, really not much changes. Mentioning accelerating the pace of government bond issuance, which has already been happening in the first half of the year. Keeping liquidity ample, that's not new as well. But what's new, though, is, as you said, the language around reining in overcapacity, regulating local governments' investment promotion practices. And this is really key because President Xi has previously questioned whether there is need for all these local governments to pile into the same emerging sectors that exacerbates the price war and the overcapacity. So that's one. Although 22V research, the analysts there are saying that even that language is sounding a little bit underwhelming given the lack of specifics in terms of targets and mechanisms as to how to rein in that overcapacity.
Okay, so maybe a bit of disappointment, but we have a bit more dates of at least the plenum, and we're thinking now circling in October.
Yes, no specific dates, but it's going to be in October. And this is important because the plenum will focus on this drafting this next 5-year plan from 2026 to 2031. And it's going to be closely watched by U.S. officials because, again, in Sweden, during those talks, Scott Bessent has warned his Chinese counterparts, or rather encouraged them to rebalance the economy. And he told them that they should make that public if it's going to be part of the 5-year plan. So they're going to be watching what comes out of that. And the Politburo readout mentioned the guidance there is about balancing between security and development. And if you read between the lines, it shows that perhaps that concern around reducing reliance on the U.S., that's going to continue to be a theme in the next 5-year plan. We have previously reported that China might be considering this renewal or a revised version of the Made in China 2025 plan, focusing on high-tech goods, maybe making things like semiconductor equipment, machines. So that likely is going to be a continued focus for the next plan.
Min, thank you. Our China correspondent, Min Lo there. Coming up, we're talking about earnings, and really what we've been talking about is with Hang Lung Properties, the chair, Adriel Chan, is joining us exclusively to go through their earnings and outlook. Earnings did fall some 14% on year there. Certainly one to watch here. But, they are seeing signs of stabilization in the retail sector in China. We'll ask Adriel Chan about that. JP Morgan also upgrading the stock to overweight overnight. We're also kind of the opens of trade in Shanghai, Shenzhen, and Hong Kong. Futures have been in the red here this morning. This is the China Show.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Fed Chair Jerome Powell. Now, we saw pretty strongly that pushback from the Fed Chair on the September cut, but markets still pricing in too. And for September, the pricing went from about 60% before his comments to roughly even odds. So it's really interesting how markets are digesting the commentary from the federal chair.
Yeah, this was seen as almost a sure thing, right, leading up to this, that we were going to get these cuts maybe September. That's been dialed back a little bit, right? You mentioned it's below just a coin toss for September. I think 80% chance now in October that we'll see a cut because of this pushback. And despite what we saw, right, 2 dissents, the first time we've seen in 30 years among the Fed, and also the moderation in growth that they flagged there, which was a change in the language. But then again, what we saw was the 2-year really kind of seeing that melt up here. We stabilized a bit in the Asia session, but we're at 393 levels for your 2-year yield this morning.
Let's bring in Adam Bowe. He is Executive Vice President and Head of Australia Portfolio Management at Pimco. Adam, great to have you with us. Let's start off with the Fed. I mean, that pushback from Powell, what's your assessment of it? Was it something that came of a sort of surprise for you?
Look, thanks for having me. I don't think we learnt that much new out of the Fed overnight. You know, we had policy on hold, acknowledgement that growth's slowing, a couple of dissents which suggests that they're getting closer to providing more policy support, but a chair that was very much data dependent in the press conference. So I honestly don't think we learnt that much.
So what is your expectation of the rate cuts that we'll get this year ultimately?
Look, I think from our perspective, when we look at the US, it's looking more and more like an economy that's growing close to 1% than versus 2 to 3% that it has been for the past couple of years. So it's certainly an economy, I think, that by the time we get through the second half of this year will require more policy support. And we think they'll get there through the second half. Before the next meeting, we're going to get a couple more employment reports, a couple more inflation prints. We think the evidence will mount by that stage to allow them to ease by the end of the year.
So, Adam, was it just optics what we heard from Powell then? That, the statement was seen dovish. He leaned a little bit more on the hawkish side. Was that sort of a compromise and he's just kind of delaying the inevitable now?
Look, I think they're managing a very delicate period where growth is clearly slowing. But inflation's picking up and they're expecting it to pick up a little more towards the end of the year with the pass-through of tariffs. So a central bank that's trying to look through that and making sure that inflation expectations remain anchored so that by the time they get to the end of the year, they can be in a position where they're easing rates. So I think it was just a very, it was quite smart from the chair to push back and allow them to gather more evidence to get to that position before the end of the year.
How should I look at the slow steepening of the yield curve? How do you position around it here right now? How far down the curve do I have to get to really kind of benefit from these steeper curves?
Yeah, it's a great question. It's a good time to be an active bond manager. We love high rates and steep curves and volatility, which is exactly the environment we've been getting. And look, you don't have to step all the way out to 30 years to benefit from steep curves. I think the best part of the curve at the moment is further in, somewhere between 5 and 10 years. You get the benefit of a steep curve to roll down, and you're avoiding the repricing in the long end due to fiscal. And so you can benefit from steep curves without stepping all the way out the yield curve.
What about for Japan, Adam? I mean, do you see enough demand for the long end of things?
Yeah, so it's almost the flip side to the Fed. Pressure around the Bank of Japan to gradually increase rates after a very long period of interest rates anchored at zero means there's more risk at the front end of the curve. When we look further out in Japan, you've got 30 years now above 3%, which when you hedge that back into US dollar terms, is up around 7%. So certainly we think there's enough fiscal premium built into the long end of the Japanese curve relative to other parts of the world, and certainly more anchored than shorter maturities in Japan, where they'll be much more responsive to the Bank of Japan as they start to normalise policy away from zero.
I mean, you alluded to some of this, but how much further clarity do you think the Bank of Japan needs now that we already have a trade deal with Japan? What is it going to take to kind of unlock more confidence on a rate hike, and in terms of signaling that we can ultimately get from Ueda-san?
Look, I think the two things that they've been grappling with, the uncertainty, is the external environment that you've noted. But we've also going through a pretty complicated political environment domestically. We should have more clarity on that in the next couple of months. As you say, there is mounting evidence that they will be in a position to adjust rates a little higher, but probably the main uncertainty for the Bank of Japan at the moment remains the local political environment.
And we've seen the fiscal concerns in Japan, in the U.S. Adam, I'm just wondering, how do I manage duration at the moment? Are there better opportunities in terms of fiscal side of things in other parts of the world?
Yeah, look, we think there are. If we look at treasuries, if you stem back from the daily volatility, 10-year treasuries actually haven't gone very far in the last 2 years. We've got a 10-year treasury rate a little bit above 430. If you look at the 2-year average, it's about 430. So we think treasuries at the moment look reasonable. Certainly if we push to the higher end of recent ranges, we'd be better buyers. But stepping back and looking more globally, there are more attractive places to own duration. Here in Australia, we have a very different fiscal dynamic. Government debt will be peaking, below 50%. And you've got deficits, that are 2 to 3% rather than 6 to 7, and similar places to the UK. So UK is going through a fiscal consolidation, not expansion. So treasuries look reasonable to us. We like the 5 to 10-year part of the curve, but even outside that, there's more attractive areas to own duration, like Australia and the UK.
Adam, it's great to have you. Adam Bowe there, Executive and Vice President and Head of Australia Portfolio Management at Pimco, joining us out of Sydney. We'll also be speaking with Goldman Sachs a little bit later on about the outlook for the BOJ and whether we may see another rate hike this year. And certainly, we are going to be counting down to that decision out in Tokyo. Tomohiro Ota joins us a little bit later on. Your pre-market, and we'll talk about your agenda here today. We are seeing a bit of downside when it comes to futures. The Hang Seng in the pre-market is down about 194 points here this morning. This is Bloomberg. Some stocks to watch at the open. Wuxi AppTech is moving to the downside here this morning. This is after that share placement. So they're selling about 73.8 million, 8 shares at $104.27 a piece here. That is a slight discount, about 7% to the last close. That's why you are seeing the shares down some 4%. We're watching JD.com. So it's been confirmed, offering to buy Ceconomy for about €460 a share there. The stock is slightly to the downside, but Meituan's the one to watch here, with Process selling down its stake in the company as it launches Kita in Brazil. We'll have more coming up, along with Hang Lung coming up.
Welcome back. You're watching The China Show. We're counting down to the open of markets. And Yvonne, we've really been seeing that anti-involution rally recently, and perhaps interesting how the Chinese president is calling for measures to end over competition. And amid all this, as we know, that has been a key factor for deflation and also these tensions with trade partners. We're seeing futures giving us a bit of a softer pointing to what we're going to see potentially at the open.
Yeah, maybe a bit of disappointment on that Politburo meeting. Yes, they did stress anti-involution, but then again, I think traders were still expecting for some sort of stimulus, particularly in the property side of things, maybe, or even consumption, right? Given the talk about cash handouts to people, encouraging them to give birth and whatnot. So maybe a bit of disappointment there today. But yes, this rally has been sort of petering out a little bit of late. That consolidation there. But there you go. We're seeing CSI 300 down about 1/5% today. And you mentioned anti-involution. It really has been the commodity that have been benefiting from that. And once again, they are heading lower, right? Take a look at steel rebar, iron ore, copper as well. We did see copper prices move globally on the back of Trump. And, he had this exception when it comes to those 50% tariffs that do go into effect soon. But they exempted refined materials from that new 50% tariffs on the metal. So that's why we're seeing copper prices perhaps tumble there. And along with this letdown that we're seeing from the Politburo meeting. HSBC, those earnings came out yesterday, but it seems like the stock is down some 2% here right now. Hang Seng is down about 1%. HS Tech is selling off. Perhaps it's due to Meituan, right? So Process selling that stake that they have in the company here. It's interesting. They just launched Kita in Brazil. This is also where Process has another app that dominates, right? And maybe that's why we're seeing this sort of them selling down that stake. So that's why we're seeing the stock down about 3.5%. But it is bringing down maybe some other of the food delivery sort of applications there here today. Watch Alibaba, we're down some 1%. JD also down some 2%. But they also did confirm, JD, that they will be taking over and buying Ceconomy. That's the German retailer there for 60 euro there a share in cash. So there you go. So things are selling off here. There is continued consolidation. Keep in mind, we also did see HKMA stepping in once again to defend the peg after the dollar sort of strength and the persistent strength we've seen for the past month as well. So I'm losing count how many times they've actually stepped in, but certainly they had to do so again, given the pressure that we're seeing on the upper end of that band. Property, that's the one to watch, right? 1.4%. But then again, we're watching very closely Hang Lung. It's still one of the key beneficiaries and winners here today. The stock is up some 3%. It's about an earnings story as well. Budweiser has some pretty good numbers as well. So a lot of things are moving right now. You're watching PMI numbers, Adriel.
Yeah, and we were expecting contraction to be about the same as what we saw the prior month. 49.7 was the previous reading, so this is a bit worse. 49.3 on the manufacturing PMI, and this is, of course, not that good of a result of sorts, but against the backdrop of perhaps some expectations of resilience in the manufacturing sector now being dented. Non-manufacturing PMIs, we're also seeing it coming in at 50.1. Which is roughly in line with expectations. We were seeing some survey expectations of it coming in at 50.2, so it represents an expansion when it comes to non-manufacturing out of China. Yvonne.
Yeah, and Bloomberg Economics talked about this a little bit, right? They expected growth to start to decelerate in the second half of this year. Early signs of a slowdown possibly were going to be seen in these PMIs for July. So you're starting to see whether it's high-frequency data, tentative signs of exports slowing now, despite the fact that we're still in this trade truce with U.S. and China. So certainly that's one to watch. Obviously, there's also the summer travel season. Maybe that could help in terms of the services side of things, but we'll track that once we do get more data on that front as well. But in terms of movers, we talked about the copper price. We talked about what's been going on with the miners here as well. So we saw iron ore, copper also fell on the back of what we did not hear from the Politburo readout there. So we did see here Zhejiang Mining, Jiangxi Copper, they are falling along with the copper price this morning. Watching chips, obviously Samsung had an interesting sort of results there when it came to earnings. So following what we saw with all the Mag 7 doing very well, like Meta and Microsoft overnight, you are seeing at least a bit of a positive follow through in some of these tech shares as well. The chip arm of Samsung also logging a big profit miss, though. That certainly was one thing to watch when it came to the stock. In terms of CATL and Prada, Hang Lung, so CATL, that was an analyst action there after their earnings that came through. So it's an earnings picture there, 33% growth in terms of net income. The shares are down this morning in Hong Kong. Prada, that's the big one, seeing downside about 9% right now. Hang Lung, though, okay, so things are actually looking okay in terms of the property side of things. So we're up 3%. Earnings were slower, about 14%. Revenue as well. But there are signs that maybe things are stabilizing there. So certainly that's going to be the key focus for Hang Lung Properties as well. One of the big winners on the board in HSI here today. I think The Budweiser APAC is also doing quite well on the back of those earnings today as well. Let's focus a little bit more on Hang Lung Group, though, saying that the retail sector in Hong Kong is likely to remain challenging in the second half due to external economic factors. The company and its separately listed property arm have just reported earnings results for the first half. Joining us exclusively now is Adriel Chan, chair of Hang Lung Group and Hang Lung Properties. Adriel, it's always great to have you. So earnings still seeing a bit of a downside there, but then again, the guidance that you mentioned there of stabilization, particularly in the retail sector in China. The headlines don't really seem that way, but what are you seeing on the ground?
So first of all, our earnings are kind of blended. We have both development properties for sale, and then we have our investment properties, which is mostly China leasing. And if you separate out the development properties, which we sold less of this year, actually China leasing is flat. Our rental revenues for retail properties is flat, which I think in this market is probably not too bad, even though tenant sales are down just low single digits. So what we're seeing is better than expected, definitely. I think everybody was a little bit nervous first half of the year, but come second quarter, we really saw a little bit of a pickup in the retail sales. So in terms of the trajectory, it is looking like it's on the right track, even if rental revenues are down slightly.
Are you more optimistic on the retail side over the office side of things? I mean, you mentioned a lot in the earnings about the uncertainties, whether it's about trade, tariffs, as well as with interest rates right now. Is that going to impact more on the commercial side of things?
Absolutely. So the offices are still struggling, both in Hong Kong and in mainland China. Even more so in mainland China, there's a huge you could say a glut of office supply and not that many people looking to expand. Over here in Hong Kong, what we're hearing is even though there is a lot of supply, there are some banks that are making announcements about coming back to work in the office. And so in Hong Kong, even though we've been in this sort of prolonged slump for office market, it does seem to have some green shoots. Let's hope that that picks up. Back to mainland China, so retail does feel a lot stronger than offices for me.
Adriel in Singapore here, does that include for prime shopping malls, for luxury? Is that the same read-through?
Absolutely. So luxury in our malls, I think, has outperformed the results that they have just been reporting. Their results came out yesterday and today. So it's been better than most of the first quarter. Second quarter definitely better, and all of this a lot better than second half of last year. So we do feel like the worst is probably behind. We're seeing a slight pickup. We're hoping for growth in Q3.
What about when it comes to pre-leasing on your new Hangzhou project? Is there a lot of confidence there as well from what you're seeing initial stages?
Absolutely. Hangzhou is one of the most dynamic, if not the most dynamic city in China right now. And the demand for that has been high. We've just announced that we are actually expanding our footprint there through a joint venture, through a partnership. So we're trying to invest even more in that city because we have that conviction.
How are you dealing with maybe the bit of consumption habits that are changing, right? I mean, there's a shift into new consumption now. There's people in Hong Kong heading up north to consume. What is Hang Lung looking in terms of anything when it comes to GBA?
In terms of GBA, for now, this is probably not the time that we're looking to expand heavily in terms of CapEx. So I don't think that you would expect to see us make any big announcements in the near future. That being said, we have been looking at ways to increase our footprint with relatively less CapEx. New consumption is on everybody's lips. The Labubu craze, Pop Mart and Lao Pu, all of these are our tenants, and we're making sure that we have exposure to the best tenants.
What's holding you back on GBA expanding there in particular?
It's just been a matter of timing and opportunity. We haven't found the right plot of land at the right price, although clearly prices have come down, so there's a lot more opportunity these days.
Adriel has a question.
Oh, I was just going to ask Adriel, I mean, when you look at the outlook, you alluded to some of this earlier for commercial property. What about the risks from what we're seeing in HIBOR out of Hong Kong? Like, is that something that is being put into the consideration when you consider the outlook?
Yeah, obviously, interest rates have a huge impact on real estate companies, from valuations to cost of funding, especially in a time like now where there's a little bit of jitter in the markets around the financial sustainability of some of the property names. Obviously, I think we're very comfortable where we are. We're geared at about 33 point some percent, and we should be topping out, if not now, then in the near future. So we do feel like we're in a pretty comfortable place. That being said, obviously that is going to put pressure if HIBOR goes up, but our cost of capital actually, or our cost of borrowing over the past half has actually come down. So we're making sure that we're doing everything possible to prevent that risk.
There are some potential assets that are on sale right now. I'm talking about 11 Skies with New World. I'm wondering, is Hanlon looking at this at all in any way?
As a responsible operator, I have to look at things that are in the market. That being said, I don't know that this is an asset that's right for us.
Adriel, what are you most optimistic about? I mean, it's interesting as well how we've seen that fair bit of resilience on the mainland. Now we have sort of that trade backdrop that seems to be improving, even though the latest data doesn't seem to point that way. In terms of consumer habits, what do you think would lift spirits, so to speak?
I mean, we do come back to the new consumption. There are pockets of positivity in the mainland Chinese consumer markets. So we're just making sure that we have access and exposure to those names. Obviously, luxury is slowing a little bit, but if you compare it to the pre-COVID numbers, they're still up somewhere between 70 to 90%. So if you talk about really how they've been growing over the past 6 years, it's not that bad. And I think that a lot of times that nervousness is maybe a little bit misplaced. So I actually don't feel that bad about the future of retail in mainland China at all.
In Hong Kong, though, I got to ask you about the residential side of things, right? We've seen prices of new projects are continuing to fall slowly and almost at par with what you're seeing in the old and existing property side of things. Do you expect developers to continue to scout these new projects further?
In Hong Kong, I feel like the prices have come down quite a lot. If anyone's in the market for a house, it's probably not a bad time to buy here. That being said, I would hesitate to call the bottom. I think we might trundle along the bottom for some time. I don't see any immediate reasons for the market to pick back up. That being said, I also hopefully, and at least for the time being, don't see any reasons for the market to go down further either. So we might trundle along for a while.
Adriel, always great to have you. Adriel Chan there, chair of Hang Lung Group and Hang Lung Properties. On the back of those earnings, we got plenty more ahead. This is Bloomberg.
Let's take a look at chip stocks and how they're faring. Of course, there are two things happening here. We've got really strong earnings from some of these U.S. tech names, Meta and Microsoft. The revenues were a beat, outlook looking solid, but here in the Asia Pacific, there's a bit of counterweight coming from Samsung and its chip division, reporting this quarterly profit that fell far short of expectations. So reflecting a deepening crisis at the world's largest memory chip maker. And of course, Yvonne, we saw the unit reporting operating profit of $288 million. This is versus the analyst average projection of $2 billion.
Let's bring in Samit Shah. She's been watching this overall, and really, what's behind this slump in the chip division for Samsung?
Yeah, so the June quarter earning was largely in line with what the market was expecting, right? But of course, it highlights how Samsung has fallen behind its high bandwidth memory space, the artificial intelligence arena, behind its domestic rival SK Hynix, and of course TSMC when it comes to chip baking. So this is, again, although the market kind of expected that, it just is a sheer number that just tells you where Samsung is at right now. We've seen some of the reports that says that from 40% in HBM market share, global share of HBM in 2024, it's fallen to close to 17%. That's a massive fall, and it's been having trouble to get the qualification test from NVIDIA. So that has been affecting the share price. But of course, this month, it's been an exclusion. And when it comes to the deal with Tesla, right? But again, when it comes to the chip making business, they've seen that fallout because of the export controls on China, and that leading to that inventory cost just surging because of the unsold AI chips.
Sang-mi, this was coming at sort of a time when there was some optimism that Samsung could reclaim its position on high bandwidth memory. And we saw how, from the performance this month, its stock went up, SK Hynix was down. What is this going to mean as investors sort of search for a bottom for that particular part of Samsung's business?
Yeah, we cannot not talk about the Tesla deal. $16.5 billion in the course of 8 years. Some say it's not really a big deal when it comes to just a breakdown in annual terms. But again, it does highlight how the founder business, which investors had put almost no value in, is now they're saying, well, Samsung can actually do contract manufacturing. And this will also boost the utilization for the Taylor plant that they have in Texas, which has been struggling with the construction. And again, as going back to the share price, it's gained 10% for the past 3 days since the deal, and it's headed for the strongest monthly performance in over 4 years. So that alone kind of highlights Samsung single-handedly boosted Korea's benchmark Kospi in July alone. So that there's that optimism there. Investors are saying that this is the bottom and it can't get any worse. And they're again kind of making their bets on Samsung making foray into that advanced HBM and ultimately win that qualification from NVIDIA.
Sang-mi, great stuff. Thanks so much. Bloomberg Sang-mi Cha. In other earnings news, Prada's Hong Kong listed shares in focus after it posted a 2% sales drop in the first half, and that dragged overall group revenue just below estimates. And the company cites a challenging environment, weak consumer confidence, and fears of Trump's tariffs and how that might trigger inflation in Asia and Europe. Prada shares down more than 20% this year. Yvonne?
Yeah, we're seeing a 10% drop in Hong Kong on the back of those earnings, right? And analysts are saying it's really kind of a split between two halves, right? Miu Miu, you're seeing growth. Prada brand, though, turning negative for the first time as well. In terms of the other side of things, right, continue to focus on those tech earnings in the U.S. and Mag 7. NASDAQ futures are up pretty punchy, 1% or more now after what we heard from Meta, Microsoft, and Qualcomm and their earnings, 11% in the after hours from Meta in particular, after that strong third quarter report, right? You take a look at what the sales forecast is, that they continue to really invest heavily into AI. We have Bloomberg Technologies' Ed Ludlow with more from San Francisco.
Meta had a really strong quarter, and its projections for the current period also were very strong. But the bit that surprised was the commentary that capital expenditures in next year, 2026, will grow at a rate that is above this year. They'd narrowed the capex range to be between $66 billion and $72 billion as they continue to invest in infrastructure, data centers, but also top AI talent. And while the bread and butter business, advertising principally, is doing really well, they're basically saying that this will keep going and that they will continue to raise the investments that are needed to do the data center build out, to hire that top talent in the AI domain. There were some interesting disclosures in there. For example, in the quarter gone, AI smart glasses, the Ray-Ban Metas, outperformed and grew in the quarter while sales of Quest dropped. And I bring that up because earlier in the day, Zuckerberg had tried to explain what superintelligence really looks like, how people will interact with Meta in the future. But a lot of the emphasis on the call from the executives was about how the investments in AI were actually paying off internally first, helping product teams do better. And then you have Microsoft, really similar story on record spending, but we got some data points that are really interesting around Azure. So overall, Azure cloud growth 39% in the quarter, above estimates of 34.2%. But for the first time, Microsoft is telling us in dollar terms how much revenue they're getting from Azure, stripping out all the legacy products. So in fiscal 25, the quarter that just ended was the fourth quarter of fiscal 25, they booked $75 billion of revenue from Azure. That compares to $112 billion from Amazon AWS. So they're like still a distant second. But clearly, this is something more tangible. Investors can see the capital expenditures, which are similar on a full-year basis to Meta's, but also the top-line growth that's resulting directly from AI. Some other interesting points as well, 100 million monthly users of Copilot, indicating that across enterprise, but also knowledge workers, individuals, their own AI offerings are starting to gain traction with a broader base. This is Ed Ludlow for Bloomberg News in San Francisco.
Subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions we talk about and become part of the conversation by sending us instant messages. Check it out at TV Go. Plenty more ahead. This is Bloomberg. Well, of course, we just got that data 20 minutes ago when it comes to PMIs out of China, and this is really quite worrying signs we're seeing in manufacturing because the contraction is more than expected and indeed to a 6-month low at 49.3, so raising further concerns. Are some of these signs further emerging about exports slowing at a time when there's still weak domestic demand? And certainly, we also saw that further slowing when it comes to non-manufacturing, that measure of activity in construction, in services. This fell to 50.1 from 50.5 in the last month. So maybe putting that together, Yvonne, along with maybe some expectation, disappointment from the Politburo, maybe how investors were expecting some stimulus, and this is what we're seeing across markets at the moment.
All right, yeah, certainly that is going to be the key focus. Earnings as well, right? You see Budweiser, APAC on the back of those earnings. Hang Lung Property, one certainly seeing more signs of stabilization there, according to Adriel Chen. So earnings still going to be a key driver for some of these stocks here. We have more coming up in the next hour.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Fed Chair Jerome Powell there, and welcome back to the China Show. Here's a look at the Hang Seng half hour into the session, really coming under some pressure there, 1.4% down, and it's trading near those session lows. I think not helping is the data that we got in the past hour from China and how that manufacturing sentiment is looking pretty soft, pretty tepid, and this is coming against the backdrop for the broader markets of a Fed chair who sounded more cautious than expected. Keep in mind as well, we had 2 dissenters for the first time since the 90s. These Fed meetings only going to get more contentious going forward. On the region's benchmark, the decline of 1/3%. This is for, I think, the 5th session, which is its longest losing streak since December last year. Of course, it's also about these trade deals that we're seeing. 15% for South Korea, but Samsung's miss is the drag in tech today. And of course, keeping a close watch on what we see in the open in the next hour in Indian markets. For now, futures are looking pretty flat. 25% is where Trump sees these levies for India, Yvonne.
Yeah, 25%. That threat certainly is big, right? For a nation like India, who, we were talking about, they were in the front in line when it comes to trade talks with the U.S. And now we're talking about a tariff level that is among the highest in the world here right now. When you have the likes of Japan and South Korea getting 15%, you have Indonesia, Philippines settling for 19%, Vietnam is 20%. So what went wrong there certainly is one thing, but it's interesting those futures have stabilized a little bit. We're watching the rupee very closely when things do open up. But as you mentioned, right, it's the disappointment, the double whammy that we're getting out of China, right? So things are already consolidating in this equity rally in the mainland. And now you have not that much stimulus news coming through the Politburo readout. You also, the PMI numbers are showing now some cracks, in particular when it comes to exports and maybe things slowing down the manufacturing side of things. That certainly doesn't bode well, despite the fact that, we're still waiting for any sort of trade truce to be extended between the two nations.
Yeah, against the backdrop of that weak domestic consumption, how clear is this shift to kind of reposition the economy away from manufacturing driven at a time where that pillar for the Chinese economy does also appear to be struggling a little? Let's bring in Rahul Chadha. He's CIO at Shikhara Investment Management, and he joins us from New York. Rahul, really good to have you with us. Let's start there. I mean, these concerns about the Chinese economy kind of bucking the signs of resilience that we've been seeing previously. How concerning is that to you at a time when perhaps Chinese stock rally had been gaining steam?
Yeah, so I think some green shoots in terms of better Chinese consumer confidence are emerging, but like the way the PMI data showed, there is a pressure which is coming from exports. What we saw was fair bit of a restocking happen ahead of the tariffs, so which is where the slowdown in exports is happening. But if we don't have the worst case outcome on tariffs play out between US and China, which our base case is, then the consumer confidence should improve from here. And you should see the pickup in the economy. See, China is not going to go back to the historical growth rates. I think the growth rates are somewhere between 3 to 4%, etc. And which is why one has to be selective about the stocks one picks over there. But things should improve from here.
Selective, what sectors look attractive to you?
So what we were playing in China were the global champions of China, the likes of BYD, Xiaomi's, the Chinese companies which are strong on technological expertise, etc. And that's where innovative pharma in China was something which we liked. Some of the leading Chinese healthcare companies, Hangzhou, Hungary is what we own in our portfolio. I think these are globally competitive companies. 5 years from now, we'll call them the multinational companies from China. These are companies which are building business outside the home market, like the way we discussed. The local Chinese market is going to grow in mid to high single-digit levels. So obviously, companies which are able to find new growth frontiers will get re-rated.
Rahul, we're starting to get more clarity on some of these trade deals and what comes out with these negotiations with the U.S., especially in Asia. You mentioned, China might get a decent deal. South Korea, Japan seems to be leaning on the better side of things. India is on the other side of that equation. How should I look at these markets now, given that there are now, may not be set in stone tariff rates, but there clearly is now signs of maybe competitiveness now that could be differing in different degrees?
Absolutely. So Korea is a market I'll take first. This is a market we've liked, and we particularly like because compared to Japan, Korea was underweight. Valuations are 30-40% cheaper, and Koreans offer a superior value proposition. They're a lot more flexible than the Japanese in terms of doing business, etc. And I think they're going to be key part of this whole rebuilding in America theme. So we've seen the alliance between the US and Korea on the shipbuilding. A similar thing is required in the US infrastructure buildup, particularly the power infrastructure. Sitting here in New York, we face the power outages almost at all times. Summers are torrent here. So clearly, I think you see the Korean transformer companies supplying to the US grid, etc. So that's a good positive story. And the tariff outcome is positive. So our view is every 12-15 months, this is going to be a story where US administration is going to take out the trade deficits they have with the countries and ask them for more. So it's going to be a mix of better access, invest more in the US, and that's going to go. On the India case, clearly the 25% number which we see, and we all know that these numbers are subject to change, negotiations, etc. is clearly a disappointment, much higher than what one was envisaging before, looking at the fact that India was a geopolitical ally. But I think that's more to do with the fact that India held out on opening the agriculture market. And what we've seen in the US also is the administration is under pressure because of these Epstein files. President Trump is losing some support between his core MAGA base, etc. Ahead of midterm next year, they wanted some victory. So the hope is that India provides some bit of a concessions on the agriculture side. If anybody can sell this agriculture reforms, is the Modi administration to the people. And look, economic development benefits the farmers more from a higher land prices than anything else. So I think one would like to see more reforms, more opening up from India in this case.
The India market, though, it has been a bit of a laggard if you compare to the rest of the region, right? And really, it says there's signs of things are maybe slowing down there and the like. I mean, how should I position around India now? Is there room for a catch-up, you think?
So I think this year India may continue with a bit of an underperformance. What you're seeing is kind of an household balance sheet repair which is going on. We've been talking about this for a while. Last 2 years, we had kind of an unconstrained, unsecured debt growth in the economy, consumer lending growth in the economy, which was kind of a clamp down by the central bank early last year. So that takes its own time to get digested. And that's what the correction we are seeing. We are seeing the rate cuts having their impact on the economy, and things should improve. The rural part of the economy is doing much better than the urban. Our hope is by late Q3 or early Q4, you should see signs of urban recovery also. See, from a medium-term structural perspective, India is one of the strongest economies with low debt to GDP, strong FIS status, etc. Near term, like the way we saw in 2016 or 19, when you've got a global recovery, the North Asian economies play the catch-up trade. The valuation there are much kind of a cheaper compared to India. They're under-owned. They're kind of a more pro-cyclical. So India also underperformed in 16 and 2019 and caught up the year after.
Rahul, negotiations could continue, though, between the US and India. How much of that negative sentiment do you think is already priced into Indian markets?
If we look at an economic impact, there's not much impact on that. I mean, India's kind of trade surplus with the US is barely 50 billion. So it's not a significant number in terms of the trade. Also, India is a very domestically demand-driven economy, so that's not much. But what this uncertainty on tariffs with the US does is a lot of businesses which were looking to evaluate India from a China +1 strategy would put that on hold, would move to other markets. So that's really pushing out one more angle of the India growth story, which was manufacturing kind of coming to India from China. So obviously you want that uncertainty to go away as quickly as possible, which is why the hope is that negotiators on both sides find a solution which is palatable, acceptable.
I wonder how you're viewing some of the more developed markets within Southeast Asia, for example, such as maybe Singapore. I mean, the region is kind of being bogged down in a way, not just because of trade tensions. There was a border conflict in the past week. How are you viewing perhaps some of the opportunities beyond East-North Asia or what we're seeing in India?
Yeah. So if you look at Singapore particularly, look, large part of that market is banks, which are fairly valued. So we don't see much upside over there. But what we like is the consumer platforms, the likes of Grab, which are domiciled in and get a sizable part of their revenues, profitability from Singapore. So those are attractive platforms. And with the recovery in ASEAN, which comes because of trade kind of uncertainty now coming through, which comes because of rate cuts and growth acceleration, these are the platforms which are going to grow, basically. They're gaining a higher share of consumer wallet. They're improving their stickiness also. Competitive intensity is also mellowed down. So we would stick to the large consumer platforms like Grab.
Rahul, great to have you. Rahul Chadha there, CIO at Shikhara Investment Management, joining us live from New York this evening. Still ahead on the China show, ANZ joins us to discuss the impact on economic growth of Beijing's drive against excessive competition. What came out or what did not come out of that Politburo meeting? Raymond Yeung, ANZ Chief Greater China Economist, joins us there. They recently just upgraded their growth forecast for the year. This is Bloomberg. One of our top stories this morning is China's top leadership emphasizing again about its determination to reduce excess competition in the economy. That was really sort of the gist that we got that came out of this Politburo readout, right? But what was it short of in terms of details? Well, if you were anticipating some sort of large-scale stimulus, you didn't quite get it here. Leaders instead saying macroeconomic policies must be strengthened when necessary, pledging to ramp up government bond issuance and fund use. They also say monetary policies should keep liquidity ample and reduce borrowing costs. This on the backdrop, what we got in those PMI numbers, which did pretty much disappoint across the board here. Let's bring in Raymond Yeung, Chief Greater China Economist at ANZ. They recently just upgraded their China 2025 growth forecast as well. Raymond, it's always great to have you. What was missing, do you think, in this Politburo readout that you were looking out for?
No, I don't see any chance for them to have a very similar big package just as last year. I don't expect this will come this year. By reading the script, I believe they just want to maintain the current pace of the stimulus effort, the growth supportive effort. And also they mentioned about fine-tuning and executing the stimulus program, which means that they probably not aim for quantity expansion, but more on the quality of the stimulus package that they have already announced in the last few months, and make sure that they execute and maintain the pace and achieve the 5% growth this year.
To be fair, right, the numbers have been decent, right? The growth numbers have been strong, and the GDP numbers as well. We have some sort of framework with the U.S. I mean, are those kind of the big factors on why they can hold off on stimulus for now?
Well, I think the long-term policy for them for China is to boost the domestic demand, specifically to try to boost the consumption, to rebalance the economy. But the immediate threat to the economy is actually more domestically related than external related. I always talk about the deflation pressure in China, and even if you look at the number, PMI number announced earlier this morning, and I am paying less attention to the overall PMI, like 49.3, but more on the input and output price index, which are encouraging. You know, the two indexes up by 2 percentage points. So I think that would be related to the recent effort they call it anti-inflation, and try to avoid over-competition and excess capacity, you know, in the economy. I think this is more important than, to me, than the trade talk and the percentage of the tariff imposed by the U.S.
The price wars, this whole anti-inflation, we've had so many guests say, you know, it's so different now than 2015, 2016, the supply side reforms you said there. This is more targeting the private sector, so it's a bit harder to reinforce as well. What is your take overall, and how can it actually deliver? And because you mentioned reflation in your reports.
Yeah.
That's a strong word.
Yeah. The reflation effort obviously is trying to be very similar to the 2015. You know, my point of view is more about reducing the level of inventory in the property sector and reducing the excess capacity or the obsolete capacity in the manufacturing sectors. And now obviously the state-owned sector will also play a major role in terms of the manufacturing investment. But at the same time, for the private sector, of course, it's more to do with the how they're going to persuade the private sector that this is very important, you know, for survival. And through the market competition in the last 2 years, in fact, we've seen some consolidation of the manufacturing sector. So the capacity will started to reduce and started to fall. For example, the EV sectors was very, very strong, and but there are lots of players, a few hundred players 2 years ago, but now it's down to maybe the top 10 or the top 20. That will be the path for the anti-inflation, you know, to move forward.
So is it going to take a significant hit to jobs, to growth then, when you're talking about these particular industries?
Well, this particular industry is probably not less to do with the youth unemployment that we usually refer to, like 14 or 15%, very huge level of unemployment for the youth. Because most of these sectors, we call that new productive forces, is already run by robots. And AI is a very automated system anyway, so they don't create that much jobs. Compared with the services sector, for example, real estate services, that's employ a lot of people. Food and beverages, that's employ a lot of people. So these are the sectors that if they really want to stabilize employment, which is the top priority in yesterday's statement at the Politburo, I think that will be that they need to have more policy to support consumption and the service sector recovery.
Does that mean these subsidies, these trade-in programs, does it have to expand beyond just what we've been seeing so far? Does it have to go into services, for example? Some people are speculating.
They have earmarked, 500 billion, to support consumption this year, and I do believe that the local government, especially for the big or wealthy, richest provinces in the coastal region, they also mobilize their own financial resources to support consumption as well.
I want to get your take on this upgrade that you have for 2025. I think you were probably one of the more bearish on the street for some time, and now you're probably one of the more optimistic economists out there. What's behind that big shift that you're seeing in growth?
Don't forget that I was probably our bank's the first one to upgrade GDP early.
Yeah.
Right in the middle of January, we had 4.8%, but after the Liberation Date, we downgraded because of the uncertainty.
Yeah.
But of course, it's the situation of the trade talk with the U.S. very fluid. And as we were talking about a global tariff, not just a tariff to Chinese goods, but to the whole world.
Yeah.
So at that point in time, we decided to downgrade it. But after the last 2 or 3 months, that we're pretty clear that the U.S. and China, both sides want to seal a deal, and they don't want to escalate the trade tension because of the very established supply chain. So this gives us, some confidence that the growth momentum in the first and second quarter will persist, towards the second half of the year.
What about for exports? If we're starting to see signs of things cracking in the PMI data, what does the rest of the year look like when it comes to the export center? And can it continue to still be a pillar for growth?
I do think that today, I won't pay attention too much, to today's number too seriously in terms of gauging the second half export outlook. Because some of the front load shipments happened perhaps 2 or 3 months ago. But then if we look at the electronic supply chains, we will look at NVIDIA ordering TSMC chips in order to support China demand. That is a good sign and positive news to the second half outlook of China. Ultimately, Chinese export to the U.S. is not really price elastic, so the impact of tariff is not that huge because the Chinese product is very difficult to replace and substitute. So I think that the second half outlook for export value would be pretty stable because of the structural shift and the structural impact of the AI development around the world. So that will be a key support to the Chinese export over the next few months.
The news, we're getting some signs of maybe of these subsidy programs, right, and what they could actually be doing. What we heard yesterday, a few days ago, was about childcare subsidies, right? If you have a baby, you get $500 and the like per child. And now we're seeing Beijing City, in just the last couple of minutes, they're announcing a childcare subsidy program and these measures to enhance the birth support. Obviously, there's a structural side of things here, the declining birth rate. Is this more about consumption policy, you think, or more about population policy?
I think it's a bit of both. It's also because of the demographic pressure for China. There's no way that they want to go back to the population control, but in fact, they like to encourage as many babies as possible. But of course, it's not very easy for them to simply use the subsidies to boost the birth rate in China. In the end, what matters to China is the total factor productivity improvement in order to increase the wage growth rather than having the quantity of labor input to support growth. I think that's very important for China to continue to have the innovation and technology improvement to sustain the growth. And we talked about in October, there will be the fourth plenum. And they're going to talk about the 15th five-year plan. And I think that the tech and innovation will continue to be the major growth driver in the next 5 years.
Will property continue to be the drag then? Do you see a bottom anytime soon?
It is very difficult to see a recovery given the level of inventory. It takes more than 2.5 years or even close to 3 years to digest the current inventory level. It's not easy.
Raymond, good to have you. Raymond Yeung there,
Thank
Chief
you.
Greater China Economist at ANZ as well. We're checking the property names in particular here, just given what we saw and maybe what we didn't see in that Politburo meeting. This is perhaps part of the economy that does need maybe some stimulus there, and you are seeing a bit of disappointment in the likes of Sunak China. There, we're down some 6%. Wanka's also down some 6% here today. Plenty more ahead. This is Bloomberg. All right, in terms of movers here this morning, we're watching some of these baby stocks, right? So Beijing City now announcing some childcare subsidy programs there. So ways to enhance the birth support. So you're seeing the likes of BMA, Jingxing Fertility are up. It's a mixed picture, though. You're seeing the likes of Kids Wants and Bright Dairy heading lower. In terms of chip stocks, obviously the Samsung earnings has been one thing, a bit of a letdown there in terms of the chip business. So logging the big profit miss there. So that's why Samsung's down 1.5% and dragging the Kospi here this morning. But SK Hynix, on the flip side, doing quite well. We're up 3%. Taiwan Semi also catching a slight bid here this morning. And of course, we're checking the yen. We're checking BOJ. It could be happening any minute, any hour now, really. But we're seeing a bit of strength coming into this BOJ meeting. They're largely expected not to do anything, but looking to see what they have to say, of course, on the back of the U.S. and Japan coming out with this trade deal as well. Plenty more ahead. This is Bloomberg. .28 a.m. in Tokyo. Japanese markets are going on a lunch break in just a moment. Of course, we're also focusing on India as well, with what they're waking up to here, with the U.S. threatening 25% tariffs on the country, right? So they were talking about, obviously there's economic sort of choking points here, whether it's the agricultural sector and the like, but also geopolitics and how India has been, of course, in the relationship with Russia and buying Russian oil, the like. So there's geopolitics, there's eco, all kind of weaved into one big sort of negotiation there of complexity, I guess you could say it there. So certainly, though, futures are still slightly higher, but the rupee certainly is in focus here after we did see a bit of disappointment there on the currency on the back of that trade deal as well. So that's what to watch there, the 25% tariff on India. Seems to be one of the worst and highest that we've seen among the world right now. On the flip side of that, South Korea has gotten a deal of 15%. Let's bring in our news desk editor, Balazs Pence, now with more on this. Balazs, tell us a bit more about the Korea angle and what are the details of this deal?
Yes, hi, Yvonne. It looks like Korea managed to get pretty much a similar deal to what Japan got, except Korea got it just before the bell. There's a 15% across-the-board tariff, and it also sets up an investment element similar to what we saw in the Japan deal. For Korea's case, it's a $350 billion investment fund. The details are still unclear on that, although we have heard from the Korean side that $150 billion of that will go to helping rebuild the U.S. shipbuilding industry, which is obviously a sector that Korea is very powerful in. Crucially, for the Korean side, the 15% includes cars, clearly a great exporter in the automotive sector, are South Korean companies. So it looks like the structure of the deal is very similar. They got a favorable rate to a lot of their competitors across Asia, and generally it's been pretty well received here in Seoul.
Okay, tell us a bit more about the reaction. Is this seen as a win for Korea?
Well, certainly President Lee hailed it as a deal that creates certainty for exporters who account for 40% of the country's GDP. One thing that people here in Seoul have been focusing on very much is whether the U.S. will get greater access to Korea's beef and rice markets. That's a very emotional issue. That's a very important issue for a key part of President Lee's voter base. The Korean side tells us that they avoided those market openings for U.S. Beef and rice, although President Trump, it must be said, mentioned agriculture as one of the market areas that the agreement covers. So we will need to do a little bit more reporting. We will need to hear a little bit more from both sides to see how that actually plays out. On the markets, it's been received kind of in stride. This is something that seems like has been pretty much priced in. Korean stocks are down a little bit. That has to do with Samsung earnings. Earlier today, the won has strengthened a bit. There will be more talks going forward between Secretary Besant and his Korean counterpart today. So we will see if more details emerge on the deal when that happens.
All right, Balazs, thank you. Balazs Pence there on the Seoul side of things. Let's get to the India side of things here as well as we talk about what investors are looking ahead to at this open. Katya Dmitrieva is with us as well. So it looks like they're getting one of the worst tariff rates in the world right now. And this is a nation that is a geopolitical ally. They were first in line when it comes to these trade negotiations. What happened?
Yeah, it is. I mean, it's not just the highest in the region, it's the highest in the world. And this is a country that is very important to the U.S. in the region as sort of this counterweight to China. We keep hearing about that. And it's also a big source of some imports, like smartphones. So really important imports for the U.S. And it seems like what we come back to time and time again is that the Trump administration has issued these tariff declarations. He is going forward with tariffs, and he is going forward even when it could potentially hurt the U.S. in the long term, both economically but also geopolitically. And we saw that sort of we're on the eve now of the August 1st deadline. We've seen that with a lot of the trade deals and kind of last-minute wrangling that's happening right now as well.
Yeah, I mean, it's in particular with India. You mentioned not just that they're called the tariff king, but also these kind of non-monetary trade barriers. But then he talks about the geopolitics of it all, right? The energy reliance that India has with Russia, for example.
Yes.
Does that just add to the unpredictability of U.S. trade policy now?
Yeah, absolutely. And the oil part is important, right? Because what we know about the India trade deal is that they're facing 25% tariffs, but there's still this unknown of how much higher that can go because they import so much Russian oil. This has been a big focus for the Trump administration. We heard, I guess now this is last week now, when the secondary tariffs, which is something that the U.S. hasn't done before, but that they'd be targeting India with because it's a large importer, as well as potentially China because it's also a large importer of Russian oil. So you have the geopolitics, you have the economics in play, and we still don't know how high that tariff rate can go, as well as all these other agreements like South Korea that we heard today. There's also Thailand, Cambodia that Lutnick just said, potentially we have a deal with. So there's still a lot to come, and we're still, basically the day away from August 1st.
And August 1st isn't even the be-all, end-all, it seems.
It's going to keep going.
Katya, thank you. Katya Dmitrieva. Also, our thanks to Balazs Pence there, joining us out of our Seoul bureau this morning as well. We're checking Japanese markets, of course. We're in the middle of that lunch break, but certainly we're going to see what this means when the BOJ is meeting. And, of course, that announcement could be happening any minute, any hour now as well. And, dollar yen on the like here, obviously been tracking the kind of the firmness in the dollar of late after that Fed. They really didn't give too much in terms of whether rate cuts are imminent right now. So that's why you are seeing, though, now that's kind of petering out. But the yen is stronger leading up to this BOJ meeting. But the Nikkei and topics are looking pretty good, right? We've had a pretty good week, really, when it comes to Nikkei 225. We're near those records, if not even higher there right now as well. So we're on watch for BOJ due any time now. Let's bring in Tomohiro Ota, senior Japan economist at Goldman Sachs. Tomohiro, it's good to have you, right? It's interesting, this BOJ meeting, right? It comes against what we just got, which is a U.S. and Japan trade deal, which is seen to be looking pretty good, 15% tariffs. But then there's also a lot of political uncertainty internally and domestically in Japan right now. How do you think the BOJ is going to deal with these two forces now?
Yeah, that's a two important kind of factors when we think about the monetary policy in the next 12 months. But we still maintain that our original focus that the next rate hike by the Bank of Japan will be the January next year. So no rate hike by the end of this year. So as you mentioned that, the tariff deal is now done. So now the many market participants are looking at the earlier rate hike before January. But we still maintain our view by kind of one big reason. That is, the uncertainty still remains. So basically, last week's deal lowered the tariff uncertainty on the tariff policy itself. So now we have a bit more visibility on what is happening on the U.S. tariff policy. So that's a good thing. But we still have another big uncertainty on the impact of those tariff policy on Japanese economy. So still, we are waiting for the very first data on those things. So it takes time. And on top of that, most important uncertainty for the BOJ is the impact of those tariffs on Japanese base wage growth. Because wage growth is the most important kind of factor for the BOJ's monetary policy going forward. So that's why we think that the BOJ will wait until January when the BOJ observes some momentum for the Shunto wage growth, which is the most important leading indicator for Japanese wage growth in 2026.
Yes, so certainly the impact of tariffs on inflation, that's one key reason why they might be holding. I'm wondering what's going on with the political uncertainty, right? And whether Ishiba is going to stay as prime minister or not. That upper house election setback for the LDP, there's a narrative going on now that this party is going to have to lean right with populist measures, which means maybe more tax cuts. How are you factoring that into overall the growth picture for Japan now?
Yeah, so still, on the political side, there are lots of uncertainties ahead. So we don't know what happened to the prime minister and what happened to the minority government. But at this moment, our base case scenario is that the current ruling parties, the LDP and the Komeito party, will maintain their kind of cabinet. So, and they maybe make a mild coalition with other opposition parties. So that's why basically that we expect that the status quo, that at least on the monetary policy. The fiscal policy, we still have some other discussions, but on the monetary policy, the ongoing the last election, 10 days ago, and the ongoing some uncertainty in the politics does not really change the monetary policy direction much at this moment.
How do you look at the fiscal concerns, right? Obviously, the JGB market has been really kind of pricing that in, the fiscal concerns on the long end of the yield curve right now. How do you see, this election outcome really impacting the likes of bond yields and inflation, if any?
Yes, so basically that's the first thing first. As you rightly mentioned, that public debt sustainability is one of the most important topics in the JGB market in the last couple of months, I think. So that is a really crucial point that we need to think about. But basically, we are relatively positive on the Japanese public debt sustainability in the short run, because now we have the inflation, and thanks to the inflation, the tax revenue is increasing, the primary balance is now improving, and the deficit is now decreasing towards zero, and the public debt, public debt to GDP ratio is decreasing. So basically, it's a good momentum is maintained, and on top of that, interest rate is still lower than the United States or in Europe. That also helps the ongoing situation. So that's why we do not really think that the public debt sustainability issue would show the very bad signal sometime very soon. But I have the one big reservation on this. That is, if Japanese government, the current government or the future government, decides to make some meaningful permanent tax cut, we have to reconsider this story, because we are currently positive on the short-term momentum. Tax revenue is increasing and others, but sometime soon, in the next 3 to 5 years, interest rate is a bit higher, coupon payment will be increased, and the budget spending will be increased because of inflation. So then we will go back, we will finish our bonus stage. So if we just decide to go to any meaningful tax cut for the future in the next 5 to 10 years, that could damage the sustainability in the 3 years ahead. So that's why if the government decides a relatively short-term fiscal easing, we think that it is okay. But if they decide to do the permanent tax cut, for example, the consumption tax cut, this is a big problem. And at this moment, our base case scenario is no consumption tax cut in the next one, at least in the foreseeable future, because our base case scenario is the ruling parties maintain their minority government. But if this situation changes, we have to seriously reconsider the situation.
Tomohiro, I'm wondering in terms of just, it's interesting, right? I think we've marked exactly a year, maybe next week, Tuesday, when we saw that huge historic meltdown in Japanese stocks, right? I think the Topix had its worst slump since 1987. It was really kind of fueled by this whole stronger yen, a lot of questions about the carry trade, and really it was triggered by that surprise hike from the BOJ. How do you look at it now 1 year on? Do you think that BOJ, have they kind of ironed out a lot of this sort of communication style and the like here? Can they actually, once they are ready to raise interest rates, will they be able to avoid triggering an exodus like it did a year ago?
Yeah, so that's clearly the communication with the market has been a problem, and potentially maybe, I guess, a headache for the Bank of Japan. So, but of course, they are learning from their own experience in the last 1 year. So at this moment, we do not really see the big surprise from the BOJ. So if they do something, then maybe they will. Basically, we do not expect any surprise rate hike today, for example. So if they want to show the market that they will raise the rate earlier, then they say, for example, September, October, and theoretically in December, then they would show something in their communication today. And today is the best timing for that because the quarterly economic outlook report will be published today. So maybe in the next 30 minutes or so, we don't know. So that is indeed kind of important catalyst for us to find out the future direction of the BOJ. But still, one big thing is, as I mentioned 5 minutes ago, the BOJ doesn't have the most important signal for the monetary policy, which is the momentum for the base wage growth. We need to wait for the early January in order to find out those leading indicators, Shunto wage growth momentum. So that's why, at this moment, we do not think that the BOJ provide any clear signal on the direction for the monetary policy.
Tomohiro, thank you so much. Tomohiro Ota, their senior Japan economist at Goldman Sachs. And subscribers can also turn to the terminal for more on this. T-Live Go is your function for the latest updates as well, commentary, analysis from all our expert editors as we count down to that BOJ decision. We got plenty more ahead. This is Bloomberg. Well, Chair of Hang Lung Properties thinks Hong Kong's residential market has yet to bottom, with no signs of the market picking up. Speaking exclusively to us earlier, Adriel Chen says he sees a recovery, though, in China's retail sales.
So first of all, our earnings are kind of blended. We have both development properties for sale, and then we have our investment properties, which is mostly China leasing. And if you separate out the development properties, which we sold less of this year, actually China leasing is flat. Our rental revenues for retail properties is flat, which I think in this market is probably not too bad, even though tenant sales are down just low single digits. So what we're seeing is better than expected, definitely. I think everybody was a little bit nervous first half of the year, but come second quarter, we really saw a little bit of a pickup in the retail sales. So in terms of the trajectory, it is looking like it's on the right track, even if rental revenues are down slightly.
Are you more optimistic on the retail side over the office side of things? I mean, you mentioned a lot in the earnings about the uncertainties, whether it's about trade, tariffs, as well as with interest rates right now. Is that going to impact more on the commercial side of things?
Absolutely. So the offices are still struggling, both in Hong Kong and in mainland China. Even more so in mainland China. There's a huge you could say, a glut of office supply and not that many people looking to expand. Over here in Hong Kong, what we're hearing is even though there is a lot of supply, there are some banks that are making announcements about coming back to work in the office. And so in Hong Kong, even though we've been in this sort of prolonged slump for office market, it does seem to have some green shoots. Let's hope that that picks up. Back to mainland China, so retail does feel a lot stronger than offices for me.
How are you dealing with maybe the bit of consumption habits that are changing, right? I mean, there's a shift into new consumption now. There's people in Hong Kong heading up north to consume. What is Hang Lung looking in terms of anything when it comes to GBA?
In terms of GBA, for now, this is probably not the time that we're looking to expand heavily in terms of CapEx. So I don't think that you would expect to see us make any big announcements in the near future. That being said, we have been looking at ways to increase our footprint with relatively less CapEx. New consumption is on everybody's lips. The Labubu craze, Pop Mart, and Lao Pu, all of these are our tenants, and we're making sure that we have exposure to the best tenants.
In Hong Kong, though, I got to ask you about the residential side of things, right? We've seen prices of new projects are continuing to fall slowly and almost at par with what you're seeing in the old and existing property side of things. Do you expect developers to continue to scout these new projects further?
In Hong Kong, I feel like the prices have come down quite a lot. If anyone's in the market for a house, it's probably not a bad time to buy here. That being said, I would hesitate to call the bottom. I think we might trundle along the bottom for some time. I don't see any immediate reasons for the market to pick back up. That being said, I also hopefully, and at least for the time being, don't see any reasons for the market to go down further either. So we might trundle along for a while.
Adriel Chen, their chair of Hang Lung Properties, there on the back of their earnings. In some of the corporate news this morning, China's CATL says profit rose 34% in the second quarter to $2.3 billion as it shrugged off weak EV demand and falling battery prices. Revenue fell slightly short of the consensus estimate of $13 billion. U.S. tariffs have added to the uncertainties facing Chinese suppliers, and those 8 shares of CATL down some 3% in Hong Kong today. Meanwhile, Qualcomm shares fell in late trading after it reported weaker than expected smartphone chip sales. Phone-related revenue rose just 7% to $6.33 billion last quarter. That's missing estimates as well. The results add to fears that a broader chip rebound may be short-lived. ARM shares fell in late trading after the chip designer forecast weaker than expected profit. The company says it's ramping up R&D to chase AI growth, with second quarter earnings projected at 29 to 37 cents a share, which was below some estimates. CEO Rene Haas says the spending surge is affecting profit in the short term. We got plenty more ahead. This is Bloomberg. All right, there are a lot of sort of way things are moving here this morning. In particular, it is very earnings driven, right? So you take a look at how CATL is doing. We talked about the earnings there. Budweiser APAC, actually, the earnings weren't actually as good, but then again, the stock is up some 1.3%. But they did talk about how, there is that China slowdown that continues to weigh on profits there. Prada is the big one, though, talking, about the earnings side of things there. We're down some 13%. And really the revenue miss on the second quarter was what was the big, culprit there, and really citing the weak luxury spending. But it's different when you look at Miu Miu, and it's different when you look at likes of Prada. Then again, you take a look at Hang Lung Properties. That's the one to watch here today. So one of the standouts among the HSI, I believe it's the second biggest mover to the upside. So they talked about earnings and revenue were down for the year, but then again, some signs of stabilization in the China retail leasing sector. That certainly was what Adriel Chen told us just a few minutes ago. And of course, we're watching Meituan. So Process, of course, they are selling down that stake after what we heard from Meituan, right? They launched Kicha in Brazil. Process also owns another big player there as well. So certainly that may be the sign of why they are selling down that stake, but certainly we are seeing that stock down some 4% on that news. Also, we're watching the likes of Kuaishou. Interesting note. So Kuaishou is number one in terms of the biggest mover on the board here. There's been a raise in the price target from Kuaishou from Morgan Stanley. So what we're seeing in the stock there, guys, if we can bring it up with Kuaishou, So they're raising the price target there to 67 from 60 on expectation of a growth in revenue and net profit. So they're talking about revenue will grow about 12% year on year. Adjusted net profit will grow 10% here. So that's largely in line with its guidance. So certainly that's the reason, maybe that's why we are seeing Kuaishou shares up substantially. We're close to 7% gains for the stock right now. That's it for us in the China Show. BOJ could be coming in any second, any minute.